Good morning, everybody, and welcome to the third series of Crystal's Complex Cases, backed by popular demand, which is brilliant. I'm your host today. I'm Dan Morris, Key Account Director at Crystal Specialist Finance. We've got, obviously, who needs no introduction, Roger Morris, who is Director of Mortgage Sales and Distribution at, I don't think he's mentioned yet, but Tandem Bank. We've also got this guy, be quiet. This guy doesn't need any introduction. He is our tax wizard from Alexander & Co, John McCaffrey.
Good morning.
Good morning, gents. Now, normally if this was a Netflix series, we'd recap on last one, what happened. Now, I think it's fair to say last year was pretty turbulent, exciting, interesting. Obviously, we've seen a lot of changes within the mortgage market. We saw a lot of rate turbulence. We saw Liz Truss bring a new meaning to staycation at number 10. A lot of changes in the taxation market. Roger shocked the financial services industry with his exit from Precise, as he spent over a decade there. John McCaffrey was close to being knighted for his services to taxation, and I just lost my hair. So it was an interesting year, but we're backed by popular demand. And as always, we're going to be speaking on everything that you guys want to discuss. There's no agenda in these webinars, as most of you know. So thank you for those that are returning. Thank you for those that are joining, and hopefully you will continue to do so. We've got a really exciting session planned. We've got some really good pre-asked questions, and we'll just see what happens over the next hour. So good morning, gents. How are you?
Very well, thank you.
Good. Really good.
Good. Good. And how's the year started, first and foremost?
John, you go first.
No worries. Still extraordinarily busy. My industry change creates opportunity, and there is certainly a lot of opportunity going on at the moment. I think with the interest rate rises, there are definitely a number of landlords who are looking at planning or exiting, or bigger players who are looking at consolidating into the market. Which in turn is driving some inheritance tax planning, that kind of thing. So yeah, it's been a very strong start to my year.
Good.
Dan, I would say, I think you've recapped that so magnificently well, and I think more than ever, the value of Crystal and the hard work that you and the team are doing, I think will be the difference this year. September really defined a specialist distributor packager like Crystal, but also the value of what John offers. So I'm a landlord. So let's just take me as the customer. I'm a landlord now, and certainly in the last quarter of last year, we'll be looking at my portfolio thinking, what's the point? How do I make it profitable? And what Liz did last year was to absolutely define the value that John and his team have. And it's now about actually getting that quality considered advice. And also from a broker's point of view, Dan, to understand the difference between joint tenants, tenants in common. And anybody who's ever listened in on one of my series of buy-to-let webinars that I did, that John mentored me, and Dan that you've been on, when we used to show that those calculations of this is the difference between personal and limited. And then I used to say, imagine if interest rates went up, I think it was 2%, possibly 3%, and everyone laughed and said, Rog, that'll never happen. But in reality, we now know it's gone even higher than that. And we originally did do a slide, Dan, a few years ago, where it showed like a 4% rate, and it looked a bit irresponsible. But we've now seen this turbulence in the market, and it'd be good if we could maybe get you to ask some opinions from both a landlord point of view and John's point of view regarding how lenders are coping with maybe increased lender fee, reduced rates, because I definitely think I've by the work I've done with John and the guidance, Dan, that you've given me as well, you've been able to really give me a different perception of what I've done with my buy-to-let. So I thank you both for that. But it's a question of what does the future hold for buy-to-let, and where can we make the changes, I think would be a good question to have within what we're talking about today.
Yeah, no, absolutely. And I think that's going to be a very hot topic. And ultimately as well, as much as buy-to-let is going to be, I think the residential space, it's certainly going to be a an interesting one this year. And I think more specialist lenders and more lenders as a whole need to do more for the market to support it, whether it's income multiples or looking at being more flexible or understanding with the self-employed, 0-hour contracts and the flexible income workers, because at the moment, there's still a lot of cases that people are struggling to place. And obviously, from a bridging point of view, no one knew what was going to happen with the marketplace. And we're getting a lot of people come to us, which are deemed as bridging prisoners because they simply can't exit onto the buy-to-let mortgages, certainly with the high street, because the income's not there from the stress point of view. So there's lots and lots we can discuss today. And there's lots and lots of questions, again, that we can discuss and have, I suppose, debates around from a taxation point of view. So yeah, it's certainly set to be an interesting one, and it's certainly set to be an interesting year. And I think from our point of view, we've started off phenomenally busy. Really have. We've had a record months all around, and not just for January's. I think well, just in general, to be honest. We've started the year really strong, and surprisingly, and not so surprising, we've seen more and more new clients, new brokers come to us with cases which historically they wouldn't have tried to place before or even came to us with before, because I suppose the stuff that we're doing for people, it's brokers deal with the bread and butter, that's absolutely fine. But if they want that holiday this year, or if they want the extra money for the kid's first car or 18th birthday, then we're providing that with the cases that ultimately they would have never dealt with before or stepped into that sector. So yeah, we're providing a lot more solutions for a lot more brokers which have never interacted with us before. And I think we're only going to see that trend increase as the year goes on. So yeah, it's going to be an interesting year, but I think what we'll do is we'll get straight into some of the pre-asked questions, if that's okay. And then anyone who wants to ask any questions, then please do put them in the Q&A box on the screen, and we'll see where the questions take us. So where to start first? Rog, we've got a couple of tandem questions if you want. I know how much you love speaking on tandem.
That's nice. So you got the questions I sent in, Dan.
Yeah. Absolutely, yeah. Because just in case people didn't know, on LinkedIn and socials, where you're working now. Right, so first question in. So do you do or do you offer product transfers?
So one of the simple answer is yes. One of the big things I would like to stress is Tandem is not a specialist lender. Tandem is a bank that actually has within its criteria specialist lending facilitation. So that means we've got the confidence, Dan, from day one to be offer a product transfer. So at the moment we're doing residential, but as we move into, say, buy-to-let and other product areas, you've got that confidence that you're going to go on a journey. But the other aspect to it, Dan, is we're 100% intermediary. So we are absolutely fundamentally against giving advice. We manufacture, we don't give advice. So yes, we do product transfers. And yes, we always do that through an intermediary.
Perfect. No, that's brilliant. Because a lot of your competitors don't do that. And again, at the moment, as it stands, the benefit of an advisor is just phenomenal. We're seeing a lot of people come to us wanting to, I suppose, speak around the clients, but there's a lot of clients that still go direct to the lender. They do the product transfer once and that's it. But actually, do you know what? By the time that comes to starting on that new rate, rates may have dropped 3, 4, 5 times prior. So there's a huge value of an advisor there, which again, we just need to educate the market on. Second question.
Yeah.
Type of commercial properties that Tandem accept, if any, and what's the max LTV?
Yeah, so we don't at the moment, because we're doing purely just residential. We don't do any form of commercial. It's just standard residential property. And we'll do that to 90% to £500,000. And by the one of the little last twist, Dan, just on product transfers, because we do give EPC discounts. If someone's midway in a 5-year fixed with an ERC and they've improved their energy efficiency to an A, B or a C, where they'll get up to a 30 basis point discount, we'll just let them take a new fixed rate with no ERCs and no new lender fees. So you could be 4 years in, Dan, you can just go and have a new product without any fees, because we feel it's the right thing to do. So not only do we do product transfers, we will give you that green discount benefit. But standard range, it's 90% to £500,000.
Amazing. Perfect. And that answers one of the other questions. So what is the max LTV possible with yourselves? By the way, guys, this isn't a Tandem specific webinar, but people have asked, so we'll give the people what they want. John, next one is for you from Aidan, which has just came in, so hot off the press. Can the increasing pressure of landlord costs be deducted as expenses in the year? So, for example, the cost of electrical installation report costs and the work that follows, and also the EPC related costs to get a property up to standard, for example, improvements or repairs to prevent damp, and also to improve insulation or add cladding, etc.
So they sound to me like they would probably be capital type expenditure, being improvements to the fabric of the building, and that being the case, unfortunately not. No, they would at the moment be added to the cost of the property and deductible if, as and when you sold the property. The only possible exception to that is if you are undertaking a repair, which is broadly defined as bringing a current item up to its modern equivalent standard. So single glazing up to double glazing is classed as a repair, that kind of thing. But if it's additional work or enhancing what is already there, then unfortunately not. It's not allowed as a revenue expense as you go along.
Dan, can I? Oh, sorry, John, you're going to carry on.
No.
So can I just be very clear about who asked the question, Dan? What was the name of the broker?
Wait there. It was Aidan.
Aidan, just to be very clear, there's been an awful lot of incorrect information for lenders telling landlords to get ahead of the curve when it comes to improving your property for what was a piece of consultation. Currently, that consultation to consider and debate through both the Houses of Parliament and the Houses of Lords for England and Wales hasn't moved forward for over 2 years. So at this moment in time, the reason why there is going to be no expected implications or increase for EPCs from E to a C is for 2 reasons. One, the Building Back Britain report says you will only devalue a property worth less than 162,000 to get it to a C, and that's because of the external internal wall insulation, which has to be done at PAS 2035, costs about 30 grand, but has consequences to health. So if you do insulate your house, you may have the consequences of creating spores and damp, which could have adverse health issues on the kids. So again, you've got to put in all form of extraction and heat insulation and all sorts of other things. The other thing is the recalibrating MEES, which is how EPCs are actually created. So MEES 11 or SAP 11 is what's being currently expected to change. So I think by 2025, the government will actually understand how accurately and correctively to legislate about the improvements of energy efficiency in the private rental section. What I would say is the government have expressed landlords should do no capital outlay whatsoever until the conclusion of this bill, because at the moment, as John said, we can't offset that as a cost, but we expect there to be a significant amount of grants and tax breaks at the moment. So for me, on this, if you can afford to do it out of your own cost and claim the money back when the property sells, great. But if not, wait till you see what sort of incentives the government will give landlords and potentially how they will change the rules, of which John will give you an update when it happens.
Perfect. Thank you very much for that, and hopefully that gives a bit of clarification, because as you say, it's still all up in the air and there's no set timelines or rules as such. We've got another question in, John. This is for you. Looks like you're going to be a busy boy today. Do mixed-use, semi-commercial, mixed-use rents where there are leased out shops rented over a number of years get taxed along with other standard buy-to-lets under the same self-assessment tax, or are these disclosed and taxed separately under their own schedule, for example, under self-employed income instead of income from land and property?
No, it's all income from land and property. So the only difference would be on a sale. So commercial properties attract a lower rate of capital gains tax. So you're paying assuming you're a higher rate taxpayer, you're paying 20% capital gains tax. On a residential property, the capital gains tax is 18%, 28%, sorry, for a higher rate taxpayer. And the other one is obviously stamp duty land tax. So pure residential, you pay the enhanced rates of stamp duty land tax if you own more than one property. Mixed use or fully commercial, you pay commercial rates of stamp duty land tax.
Perfect. Thank you for that, John. And just out of curiosity as well, obviously, you can't rely on the media. I mean, the media, all it does is say bad news and spread bad news. But from your point of view, John, from a tax point of view,
yeah,
have you seen an increase or anything at all in terms of landlords offloading their properties at the moment?
Have I? I've seen a few smaller landlords where it's not becoming viable. I've seen a number of people looking to do succession planning with properties, so pass it on to the next generation, crystallizing gains, that kind of thing. There is greater interest in corporations due to the increase in interest rates, and I am aware that a number of landlords are exiting the market, but bigger landlords are coming in and taking those properties. So it seems like there's a bit of a consolidation going on in the market at the moment.
Okay, perfect. So you wouldn't generally say, from your humble opinion, that the properties in the rental market are reducing, which is causing strain on that market?
No, not especially. No, it's different, but I've not seen a crash that has been foretold. There's a lot foretold in the media that hasn't happened, to be honest.
Dan, what you'll have though is John won't have an accurate view of that world, in the sense, because he gives such quality advice, because the people he deals with on a daily basis have listened to everything John said, and they've gone to him. Yeah, well, I know the people I've sent to you recently have just, it's been transformeric. They were going to sell, they've spoken to Uncle John and they're going to keep it. Yeah. There was a recent article done in the Times where at the moment 66 landlords leave the market as a net, a difference every single day. And this is because of the sweet spot of George Osborne's interest relief changes that happened in June 2015. What's also done as expected is that there's still a significant amount of landlords in 5-year fixes. So the full impact of what happened in September last year still won't materialise for the next 2 years, but there's still time to make a difference. 62% of buy-to-lets have no debt, but sometimes just a simple trust document moving the income from A to B can be the difference between profit and loss. And again, landlords worrying unnecessarily about EPC changes. I think the EPC changes are just as significant, with landlords getting the incorrect information as to the profit and loss. But we know, Dan, from the properties that you and I own in the Northeast, there might be high yields up there, but the tenants do tend to do a bit of damage, and you're always doing repairs, and those profits can be easily eroded. What I would say is my view at the moment is I'm seeing a lot of landlords buy new build, not flats, because of service charges. 2-bed, semi-detached with electric charging points and a sealed garden will have higher capital value over the next few years as your older Victorian properties start to come with some hidden liability, but also rental demand. Of course, tenants want to live in the cheapest property, but Dan, they also want to live in properties that offer them a much better quality of overall environment within what they're doing. So I do think the market's going to have a bit of a shake-up over the next couple of years, but landlords like me will definitely remain in the marketplace, and it offers more opportunity as there's less supply.
Yeah, no, I agree with that. And I do think the landscape will change from what a tenant is essentially looking for. If you look at the cost of living crisis, and obviously the cap on energy, which is only going to increase, and they're going to be looking, in theory, for a more energy efficient property, aren't they? And surely it's not going to be around characteristics in a property for a number of people as it is to, well, actually, if I have these big bay windows and these big exposed beams, how much more is that going to cost me than a new build property that's essentially A or B? So yeah, I think we will see are changing that landscape. And I think it comes back to what we see in every single webinar and everything that I speak around in any event that I do. It's just using the resource that's available to you, that's around you, whether it's myself, obviously Roger, or certainly John, and just having these specialists as part of your toolbox to enhance your client's journey and just offer them that support and advice process, really, because you will get, and we are getting and seeing a lot of these, what you could probably class as hobby landlords or accidental landlords, which have then grown a portfolio, wanting to exit the market because they're scared. But I think that's down to the fact of how much knowledge they have within the sector, and all they see is bad news. Bad news, the market's dead, rates are going up, your profits shrinking, and ultimately you are going to be a mortgage prisoner, which it's incorrect, because there's loads of products available out there where if the income's not working, then we can top slice from personal income or draw on background income, or do different types of products which gets them from that A to B solution and that loan amount that they need. So I think it's just utilizing the tools that you've got around you and the people that you've got in your circle, like ourselves. And I think that's the main thing. And there's another interesting question that's came in, which, if we're looking at the future and where we are, and certainly how important tech is, not even within the industry, just within life at the moment, and will continue to do so. Do you think AI software will become a valuable industry tool within the near future, whether that's on the advice side or even lending decisions?
I would, Dan, the value of an intermediary went through the roof last year, and with Consumer Duty coming, more and more lenders who in effect just do information only because they only offer on their own products, there's liability against those lenders now. And I would think we'll see maybe 90% of the advice of a remortgage of a purchase coming from an intermediary. What I think is absolutely disappointing is those lenders that acknowledge the value of full advice are still now trying to take a larger and larger share of product transfers. So the brokers that are on here today, and there's a significant amount, your customers should belong to you. And this technicality, because of privacy notices, of when a customer's handing over, the lenders are going, we don't have your skill set to advise, but we want to take the product transfer. I think that's wrong. And I think when it comes to AI, we're developing a new system for when we launch our buy-to-let, Dan, is AI is great where we can remove where advice isn't needed, and we can automate that process to remove everything from either side of your day. So it allows you clear and clarity when advising your customer. And I think what you want now is you want to be able to, that your job is to be conscious when you're with your customer, explaining everything they need to know, but the rest of the process, Dan, will be automated if it can be. But the value of advice at the moment is huge. And I think that proves itself with John. You know, you can tootle on the internet and work out how to give yourself tax advice. It's not complicated, but it is. And it needed John to explain to me at least, I think 172 times about incorporation tax relief and the Ramsey ruling, and oh God, yeah, that's right, I need to change that. So John, you would say that, isn't it?
I agree wholeheartedly with that. I work with a number of tech providers to the property industry, tech providers generally who are entrepreneurs. People like, you may have heard of Agent Software, who are big in the estate agent market. I got an introduction this morning to another chap who is working with landlords to streamline billings and services for people like British Gas and Virgin, and set up when you take on a lease. I think, as you say, or as you said, it's where there's a process, you most definitely can automate it. And a lot of people work in that market. I'm asked frequently if things like AI will overtake tax advice. There are people out there who purport that if you put in the correct information into a piece of software, it'll come out with an answer. It will come out with an answer, but invariably it's the wrong answer. I've had clients of mine come to me saying, I put my stuff into a SDLT calculator and it's saying that the figure is this, not that. And I'm kind of like, that's because it hasn't accommodated the fact that, you know, you've got a bit of commercial in there, or the value of that is X, Y, Z. The AI will be very useful in processes and streamlining processes. When it comes to nuanced decisions, it's only as good as the information entered in. And I think that's going to cause a problem.
Yeah. No, I agree. I do agree. And I don't think you'll ever be able to remove an advisor out of certainly any sales process. And I think it is invaluable, because purely when you're getting when you're a first-time buyer, you want that reassurance. You want to speak to that individual, because it is a huge purchase, and it's the biggest purchase you are realistically going to make in your life. So I think that we can bring in all this automated software, these self-driving cars, contactless payments, literally using your phone for everything. But when it comes to stuff like this, I do think that brokers are worth the weight in gold, and I can't see them ever being removed out of that sales process, which everyone will be happy with. I think lenders and providers will streamline and will embed more AI, and it's something that we've done and we are doing, certainly from a consumer duty point of view, in compliance and suitability letters and all that sort of stuff. But when it comes down to the actual sales process, speaking to that individual, listening and finding that solution for them, whether it's on the protection side of things, the tax side of things, the mortgage side of things, I don't think you'll ever be able to replace that. I really don't. It's different because it's not transactional. It's not a transactional process. So as much as it is going to be a valuable tool in certain aspects of what we all do in the world that we live in, I don't think that'll ever replace the contact and what we do as individuals. I mean, look at this now. I mean, webinars, they're a thing that realistically came out in 2020 when COVID hit, and ultimately Teams and Zoom went through the roof from a share price because we changed, we diversified, and we had to embed a different process in our lives, and it works well now. So we've got loads of people on from all over the country, which we'd never been able to do face to face. However, people still need that interaction and that engagement, because you can't talk to a computer. I suppose you could, but it'd be a bit weird. So yeah, I think it may be valuable, but I don't think it'll remove the need for individuals like ourselves. Rog, I suppose you can answer this one and I'll have a pop at it, but do you expect more lenders to look at affordability when it's a like-for-like remo, for example, to avoid mortgage prisoners?
I think lenders have got to look at what's fair with consumer duty, Dan. If that customer is with you and that customer is made the payments every single month, but on the face of it, the affordability doesn't fit, what we'll do is we'll leave them on a much higher rate. And the customers who can prove affordability, will give them a better rate. And that's not treating customers fairly. If you've got the customer with you, being able to offer them the correct fee, the correct rate, and the correct outcome for them is so important. So I think consumer duty will change that. When it comes from moving customers from one lender to another, I think consumer duty again will make that maybe easier. I mean, you've got to make sure that just because the new lender, the existing lender, Dan, may not have done the affordability correctly and maybe done the correct stress test. So it's not fair for a new lender to take on the liability of a previous lender, but it's about trying to do the right thing and think differently. So like one of the things, Dan, that Tandem have done for a remortgage is, why do we use a solicitor for a remortgage? So you come to Tandem, Dan, you've got a mortgage at the moment, you want debt consolidation. Let's just say you've spoken to one of the team at Crystal Finance and you can save 500 quid a month. You want that saving now, you want it today. The lender will offer it quickly, but you don't want to wait 3 months for the solicitor in some factory somewhere that's in effect doing lender-only legals anyway to do it. That's why we now do the legals in-house. We'll issue you directly the mortgage deed, we'll take it in, we'll pay off the unsecured debt, we'll complete the mortgage quickly. So I think it's 2 aspects that need to be looked at. Is one, where possible, where you're not capital raising, being able to offer a customer a detail for the right reasons, and that's where consumer duty will help. But the other bit is, if you can help the customer, don't delay it by using antiquated practices of using solicitors, where simply you're just moving the deed from one lender to another. So I do think there'll be a lot of change coming positively this year, Dan.
Yeah, do you know, I couldn't agree more. And I think you summed that up very well. And we're seeing more and more enter the market. And just to be honest, have a common sense approach, which is what the specialist market's about. Obviously, the high street's a different beast altogether, but the lenders that we deal with, certainly in these sectors, I think more and more are going to come to the market, and we're seeing it at the moment where there's more of a common sense decision being made rather than actually, do you know what, it doesn't fit, we'll kick it out. As you said, if they've made the payments, there's no issues on credit, then what risks are there as such from that point of view? So I think watch this space, but we should see more lenders enter the market with a more common sense approach, doing like for like remortgages. Obviously, capital raising is a completely different beast, but ultimately it's what we should expect to see happen this year, because something needs to happen. Otherwise, as rightly so, mortgage prisoners will be there and it will be evident. And you don't want to, suppose, monopolize the market and make it unfair, certainly from a consumer duty point of view. Kevin's just asked the question, so thank you for this, Kevin. So portfolio landlord, 3 other properties at 50% LTV across the portfolio. Client wants to remortgage plus capital raise one of the 5 at 150 grand. However, there's an elephant in the room, 850 rent per month per property. Research outcome max 115k, which is £54,000 less than the existing mortgage. Who would want to help this client? Any thoughts? To be honest, we've got a number of lenders on panel that would look at this case. I'm not going to go too much into detail in terms of what we'd be offering, but yeah, we could do it. We could just use background income and top size if there was any there. I'm 99% sure there will be. So it's one, Kevin, that you can pick up with us after, and we can give you some idea on costings, rates, etc. But it's definitely something that we can do and we can look at, like I say, as long as there's realistically background income there, or some of them more relaxed stressing on that particular case. So hopefully that'll help, and just pick up the phone to myself or the team and we'll be able to assist you with that one. But there's loads of options out there for people in this situation where it's not going to service and we're going to have to draw on background income. And there's more and more lenders coming into that market where they'll top size and use background income to get them to where they need to be. Thank you.
Right. What I would say with that one, Dan, was it is just about, I can't emphasize enough the help I've had from John over the years. And it's about, so if you've got your current, the rent, the yield, the return, you know, it's looking at limited companies. The concept of moving properties into limited companies can have IHT and stamp duty implications, which can be absolutely prohibitive. It could be where sometimes if the properties are in personal and you literally, you can, the cost implication of incorporation for the vast majority isn't there. You maybe have to consider selling one to reduce the debt to make what's left affordable. There might be sometimes other ways of capital raising. So you might have a load of equity in your residential. And by having equity in your residential, sometimes debt consolidation at a lower rate can actually then reduce the outstanding balances on your buy-to-lets to a lower amount at a lower rate. So for instance, let's just say you could do capital raising and you could get a period of 4 on your residential against say 6 on the buy-to-let. And within that capital raising, you might want to raise 150 grand on your residential and then utilize that money to reduce your borrowing on your buy-to-let within your tax return that John's business would be able to operate. You can still offset the percentage that you've used on your residential to be able to get a better LTV on your buy-to-let. So sometimes there's different ways to do things, but this is why you need to speak to John. But you also need to start to think outside the box of where you've got equity and where you can get your cheapest borrowing. Because John, technically, there's nothing stopping you having all your debt on your residential if you can get a cheaper rate and that lender knows what you're doing.
Yeah, no, absolutely agree. I have a lot of conversations with people about tailoring structures. So it's whether some are held in personal name, you incorporate some of them, whether you hold them in separate companies, whether you mix it all up. I work with brokers regarding the mortgages they're able to retain to get them the structure they need
Yeah.
in order to get the lending they want. And you're right, we've had conversations, several conversations with people about, well, okay, sell down your underperforming properties,
Yeah.
release the equity, it improves your situation no end.
So Dan, it's sometimes about thinking outside the box. So I'd be saying to any landlord, as a non-qualified individual at the moment, I'd be saying, right, how many properties do you have? Where's the equity? And where can you best leverage the cheapest deals? So it could be the fact that the broker can go off and refinance. We are seeing deals now at around 4%, but as long as that lender understands why you're going to do what you're doing, or it could even be take a second charge out for a short period of time, because the lender will more likely debt consolidate a second over a first. And then it's about how to bring down that debt and how to get a better overall leverage. But I've done that for helped a few of my friends in Birmingham that have changed the difference in profitability. And remember, 62% of buy-to-lets in the UK, Dan, have no debt whatsoever. So there is equity there. It's just about approaching it in a different mindset. And I don't think a lot of brokers on this webinar have been using equity leverage on reduced rates in their residential when assessing a buy-to-let portfolio. There is that increased measured risk that your home is more at risk because you've involved it in the buy-to-let. So that is a consideration. You know, not all, you know, you might be the husband and a wife and one of them's going, you're not raising money on our residential for the purpose of buy-to-let. But just remember, that asset is still there. And if it's worth what it is, if there was a problem, that could be sold off to secure your residential. But something to think about, Dan.
Yeah, no, I agree. Thinking outside the box is certainly going to be a term that we'll use a lot this year. And it's just about exploring and doing that fact finding, and ultimately just seeing what is on the table and how we can shape it. Because again, it's not down to us to decide if the client wants to go ahead. It's about providing that solution. Sometimes the cheapest solution or the only available solution. It's up to them if they want to go ahead with it. And if you look at the second charge market, I imagine out of everybody on here, there might be 20% of people that actually actively look at second charges on residential. A lot of people have given back the permissions. If you're an AR, they don't want to do it, and or potentially they just farm it off to a specialist like us, which is absolutely fine. But if we look at second charges, if we look at the relaxed, I suppose the relaxation on income, the increased income multiples, which typically you're looking at probably 6%. I wouldn't say it's self-cert, but on for self-employed clients, then income can be more flexible. Obviously, there's options for their share of the income plus their share of the net profit. And there's lots of ways and means to do capital raising. And we've even got limited company second charges on residential as well. So even if it's a case of their business needs money, so whether it's to purchase a new investment property, cash injection into the business, whatever, if you've got a limited company, you can secure a second charge on your personal property in the limited company name. It's non-regulated and it's nice and straightforward. So yeah, again, I think you hit the nail on the head there. Think outside the box is going to be the phrase for 2023. And again, if it's not a box that you want to get out of or want to think outside of, let us do it for you. Send the case to us, let us help you, and let us say, look, this is the most cost-effective way we can do it, or this is the only way realistically that we can get you the mortgage that you require based on the assets that you've got, because it doesn't stack up this way. However, if we're creative and do it this way, then there's a solution. And sometimes you might think, yeah, brilliant. Sometimes the client might think, yeah, I want to do that. Or actually, as Rog mentioned, do you know what? Regardless, don't want to secure it against my residential property because the missus will go crackers, or whatever that may be. But it's all providing solutions for the clients and letting them make that informed decision. So yeah, no, there's a few great points there. Right, other questions that we've got in. John, do you want to cover off the age-old question, which we get asked almost every single one? So, is it right for when you're purchasing a buy-to-let property that it should always be purchased in a limited company versus individual names? If you don't have any, just to put some context on this, if you don't own any current buy-to-lets and you're planning on buying your first one, is it always better and more tax efficient to purchase via limited company?
Is this on your first property purchase?
No, first buy-to-let purchase.
First buy-to-let purchase.
Don't know how much resi's worth or anything, but Yeah,
If it is there are benefits to buying a limited company if it is your first buy-to-let purchase and you don't have your main residence, right? The benefit basically is that there are specific reliefs available for individuals who buy the first main residence to live in, and there is a pretty sizable exemption from stamp duty in order to help you get on the property ladder. If you own a buy-to-let property, that exemption is not available to you because it's not your first residential property purchase. So in those circumstances, if the maths work on purchasing a company in terms of funds going in, money's coming out, that kind of thing, I would generally look to buy your first buy-to-let in a company. If you already own your own main residence,
yeah,
it's very much circumstance specific as to whether you should buy it in a company. Both you and the company would pay the additional 3% stamp duty. It would depend on what other income you've got. There is a cost to running a company that you generally don't have with self-assessment and running it through your own name. It could be you are in a marriage or some form of civil partnership and your other half is a lower earner than you. So it may be beneficial to own it jointly with them and put the income that way rather than taking on the headache of a company. If you're going to become a serial landlord, then a company is probably the way forward. So as I said at the outset, if you don't own a property, there are benefits to a company, but otherwise you would look at the circumstances of the case before saying, yes, it is.
okay.
And Dan, do you know what? There is a bit of a crystal ball here because it's like, how much are you going to earn in the future? Because how often, if you look back in your life, how much life's changed, your income's changed, and then ultimately succession of inheritance tax. So you've really got to play the long game if you're young, because at the moment you become a high rate taxpayer, it's too late to go back to being in a limited company. And with the current tax rules and tax position, it feels as if the government want all buy-to-lets in a limited company, so they really understand how they're controlled and how they work. But it's quite a complex one to get that right solution.
So the other thing about a limited company is if you're putting your properties in a limited company, but take all of your income out, it's not particularly tax efficient. So a limited company is only really a useful structure if you're happy to leave some of the funds there or have the ability to spread it around shareholders who own the limited company.
Okay, perfect. There's definitely some, again, some thought involved in that, and that just shows the value that you would add or similar if there is any other tax advisors on.
There aren't any, I'm the only one in the country.
Yeah, you're the only wizard in my opinion. Obviously, these are my views, not Crystal's. Another one that's came in, which we've discussed before, but again, just because the staycation market's very much booming as it has been for the past few years, is there a difference if you're purchasing an Airbnb style holiday let property and you use it yourself in how much tax that you will pay?
Potentially. So if you run it through a self-assessment business, and so it's not in a company, you basically lost out on the rent for that period. So that's the only way that would really affect your tax. There's no other taxes that fall out of that. If the property is in a limited company, private use is deemed to be a benefit in kind. So you would pay tax. Either you pay the company rent to use it for that period.
Is that at market value?
It would have to be at market value. And a lot of people I know do that. So they rent it out. They've got a holiday home that they use 3-4 weeks a year. And it makes sense for them to pay that company rent. They pay a little bit of corporation tax, but they've got access to that property, and then rent it out for the rest of the year and capture the profits at the lower corporation tax rates. But if you don't pay the rent, there's it's a benefit in kind charge on the foregone rent you should have paid.
And how would that be policed?
Technically speaking, you self-assess on a company. So a company has to show what its income for the years are. If you're a director, I can't say, don't get me wrong, there are people who are probably using company assets and not paying the benefit in kind. Obviously not something I'd advise. If the revenue find out, they will come down on you, and they have a long time to look. Because if you're doing that and you're deliberately evading, they can go back 20 years and add penalties and interest. So deliberate evasion gives rise to up to, well, if it's a UK-based asset, up to 100% of the tax due. If it's an offshore asset, then it can be up to 200% of the tax due. So certainly can try it. I wouldn't advise it, and it can be quite costly if you're caught.
And right, if genuine question, so if you owned said holiday let and it needed repairs which you were going to carry out, is there an exemption for you to be at the property, stay at the property and carry out the repairs or not?
Yeah, to be honest, there is, because you're not using it for commercial purposes at that point. So whilst you're there, if the property is shut down and you're undertaking the repairs personally, that's just the same really as hiring somebody to do it. So you're not presumably using it for holiday purposes. If you're carrying on with repairs and there is an element of private use, what you should technically do is split the period where you're working and the period where you're using the property for personal enjoyment.
Dan, just remember there's a lot of investigation on the revenue because of some bad practices that happened during COVID, where people claimed for what was a second home, converted it to a holiday let just to get money back in. The revenue are really hot now. There's about 56,000 holiday lets in the UK. So you've got to make sure you're being open, honest and transparent with HMRC when it comes back to interest relief. But also another factor, Dan, one of the consequences of George Osborne's reforms in 2015 was if it is a holiday let, you can still get 100% interest relief if it's in personal names. So that's why we've seen a disparity of short-term lets in London, because the rental yields don't fit conventionally because you can't offset the interest. But in London, Edinburgh, as two cities, for example, it's illegal to rent a property more than 90 days on a short-term let. So just make sure you've got the right insurances, that you've got the right permissions, and you are being open and honest with the revenue.
Perfect. Yeah, no, agreed. And thank you for that, John. Thank you for that clarification. I've just used AI and confirmed there's no one on from HMRC, which is brilliant. Right, if anyone's got any last questions, if we can get these sent in, please, because we'll be starting to wrap up soon. But we've got another one that's came in. John, over to you.
Yep.
It's a heavy one for you today, pal. If a wife owns a limited company buy-to-let currently, but no residential, can they still have the first-time buyer exemption on a residential purchase?
Assuming both parties are first-time buyers, yes, because the wife owning a buy-to-let in a limited company doesn't preclude her, because it was the limited company that purchased the property, not her.
Right. Okay. Perfect.
It's a fundamental mistake, Dan, that most brokers do make when advising customers buying their first property. They'll just look at the cheapest rate, not the ultimate consequences of the tax on their second property, which will be their first home.
Again, it's just about gathering all the information and providing that right advice, isn't it? So it's about.
Now, just to clarify on that as well, if she hadn't, if it was in her name, but he was a first-time buyer, because one of the buyers hasn't got the exemption, they both fail.
Yeah. No, absolutely. So again, suitability advice, gathering all the information, educating yourself, and just reading more textbooks, really, and speaking to more individuals like yourself, John. But yeah, no, brilliant. Thank you very much for that. Any last questions before we start to wrap this up? Because I think it's been a pretty heavy session. Again, there's been lots of useful information as always. And yeah, just want to thank you guys for coming on. But before I do start wrapping this up, before there is any, if there is any last questions, anything else you'd like to add, both of you, in terms of what we've discussed for a recap, or what you'd like to, not so much that envision is going to change or happen moving forward, but any insight you want to give to the market over the coming months?
John, do you want to go first?
Yeah, it's got to be quite interesting the next couple of months. We've got a budget coming up. I read this morning that the tax take in January was the highest it's been in a long time. And we're coupling this with the situation whereby the Chancellor is sticking to his guns so far on increasing tax rates. I'm not sure how long that will last or whether there will be any loosening in that. From 1st of April, corporation tax rates may go up to 25% depending on your level of profits, which is still better than the high rates of personal tax. But it could be quite an interesting space. The other thing, and maybe we touch on this in more detail in a later webinar, there are some really favourable changes being introduced in relation to property and divorce. So at the moment, movement of assets tax-free are restricted to the year of separation. That may well be extended to 3 years. And further if by court order. So there's a lot of legislative changes coming up in the next couple of months that may impact on the property market, which could be quite interesting.
Perfect. No, absolutely. It wouldn't be a normal year if it wasn't interesting or if there wasn't changes, would it?
No.
Right. Thank you for that, John. Roger, anything from you? I imagine.
Yeah, I think I've got just 3 points to make. One, buy-to-let. If you've got where you're doing a review with the landlord and it literally doesn't fit, then why don't you maybe write in, ask the questions of why it doesn't fit. And what we could do is next time we could do a little bit more time just to get your mindset around how you could potentially make it fit and a different approach and how to overcome objections to making buy-to-let right. Buy-to-let's never been in a better space. What you've got to remember was the shock last year was always going to come, but it was 17 years since we've seen interest rate rise. And oh my God, did the rise, you know, base rate from like 0.1 to 4%, and it still might rise a touch more. So there's a lot of shock, but when it settles down, the buy-to-let market in the UK is set to be in a better and healthier position than ever before. You've just got to help the landlords through that process. My second point would be, guys, if you could do one thing today for me, just one thing, is please go onto the Tandem website and register. So that way, when you've got your first specialist case and you come to Crystal Specialist Finance, which is the UK's arguably without doubt #1 specialist packager, you'll be able to get the right information, because there's a number of new and exciting things that Tandem will carry on reimagining the mortgage market. So please think of registering with Tandem. And the other bit is customer contact. More than ever, your customers want to hear from you. So think of newsletters and articles and information. Just remember, you are now going to be the most needed you've ever done in the last 17 years. If you're new to the industry or you've been in this for a long time, this is the year of the intermediary. So guys, certainly think and value yourself and think of charging an advice fee, because the years you've put in, you are needed now.
Yeah, no, amazing. Thank you very much. John, do you want to answer that question that just came in?
Yeah, I can. It is called a deed of trust. Any private client solicitor, that's somebody who does wills and trusts work, should be able to do that for you. I mentioned this on previous webinars. So once you have the deed of trust in place, and that transfers beneficial ownership of some or all of the property, you then need to complete a Form 17 if you are married, and submit that to HMRC. The change in rental or change in income is only effective from the date of submission of the Form 17, regardless of the deed of trust. But you do need the deed of trust first, because the revenue will require that as evidence for the Form 17. It's quite a complicated answer. If you have any problems, drop me a line, Tom.
Okay, can I just re-explain that? Because I did cock this up and it costs me, is what John's saying. If you're going to do Form 17, go online today, if that's what you're doing it. Fill out the form. It's an online form, so it digitally stamps with revenue, and you've got 60 days to send it in. So if you were filling out today, you've got to send it in with the copy of that trust document. Don't put it off, because if you think I'll speak to me account, we'll get it done, we'll do it in a couple of months, then that's 2 more months of paying the higher tax. So you've got to do it, John, haven't you? Don't delay that. Get that form filled out, and it's a self-declaration. So you've got to again be open, honest, and transparent. But don't do what I do, thinking the accountant will do it at the end of the year, because it costs.
Perfect. Just FYI, just for some context on that. So this is in relation to the trust document for the buy-to-let income, just in case anyone was thinking, scratching their head, thinking, what's that about? So yeah, we know some great value added there. So just to wrap things up, I think it's going to be an interesting year. I think, as Rog mentioned, this year is going to be the year of the intermediary, and I personally think it's going to be the year of the packager. Obviously, I'm going to say that, but ultimately we're here to help. We're here to help the cases and the sectors that you've never been active in before, but you want to take a punt at it, and you want to deal with them inquiries that you historically would have kicked down the road because you're far too busy. Put your mug down. Stop plugging yourself, because you're far too busy, and we're just here to support. We're here to educate. We want to help you earn and learn ultimately, and that's what we're there for. Whether you want to use Crystal or just see if something's possible, please do lean on me, lean on my team, and let us just educate you around anything that you need. We're seeing lots of people come to us at the moment, which normal business has dried off. So looking at hints and tips as to where they can get more business from, how they can get into commercial, into bridging, into development. My team are more than happy to have meetings and conversations with you and educate you around certain sectors so you can become experts, or even know just enough to get by in that particular sector and then learn more. But yeah, I think it's not all doom and gloom at all. I think there's loads and loads of opportunity within the marketplace. We just need to know where to look, who to lean on, and who to have within our inner circle, which I'd like to think you could lean on, all three of us, in this webinar. A date for your diary. So Dave, our head of marketing behind the scenes, works tirelessly to make sure these go well. So Dave, well done as always. Thank you for setting up another great webinar. The next one is on the 18th of April, a Tuesday, same time, same place. So please do sign up as soon as possible, and we'll see you there. But thank you very much for everybody for joining. Thank you very much for the interaction. It's been an interesting and informative session as always. So Rog, John, thank you very much for your support. Wouldn't be able to do it without you. And that's it. So yeah, thank you very much. Have a great day. Have a great week. Have a great month, and we'll see you again in April. Thank you very much, guys.
Take care. Bye.
Farewell. Bye-bye.